Yes, so I'm going to present a recent paper that I have written alongside Daniel, who's in this call, but also Dominic Hart, Benjamin Lifshitz, and Arthur Gervais. Um, so the paper is on, well, it's called The Decentralized Financial Crisis. And what the main observation that this paper stems from is this thought that as we build more and more decentralized financial architecture, are we increasing the risk that this architecture itself becomes vulnerable to the type of financial crisis that we have seen in traditional finance? So, so we'll start with the definition of what decentralized finance is. So decentralized finance is a peer-to-peer financial system which leverages distributed ledger-based smart contracts to ensure its integrity and its security. So this, of course, is in contrast to traditional finance, which is not in any way based on distributed ledgers. So really, in a sort of quite crude summary, you could think that if you take finance and blockchain and sort of clap them together, make some modifications, you get something like decentralized finance. And it is something that has great promise, or is alleged to have great promise. So here are a collection of very enthusiastic headlines about the potential that DeFi has. So, claims like, is DeFi the future of finance? Or I think a favorite here is DeFi will eat traditional finance and dramatically expand the global lending market. There is real amount of enthusiasm for DeFi and the ways in which it may be able to revolutionize finance. But as with all this excitement, it is, of course, important to also think about the risks, especially if the risks that exist in this new architecture are of a new kind. So this graph shows how the total value locked in DeFi projects has evolved over the last year or so, just under a year. So you can see that it's now a fairly sizable slice of the assets locked in blockchain projects more generally. I mean, we have a spike at just above $1 billion US dollars. And also notable in this graph is that there is some volatility as well. But this gives a sense of the growth of these fields and how much interest there is in capital terms. Okay, so what are some of the potential advantages of decentralized finance over traditional finance? So the first is really an extension of one of the advantages of blockchains themselves, which is that it reduces the requirement for financial intermediaries such as banks, and also in particular the arbitration services that such intermediaries provide. So that's the first sort of major advantage, is that we now have this possibility of a financial system that is disintermediated. A second advantage is that for low-income individuals and also the unbanked, so individuals who do not have good access to banking services or other traditional financial services, they may now be able to actually access financial services through this trustless form of financial architecture. It should be noted, though, of course, there are risks here as well. So perhaps the major risk is that in exchange for decentralized architecture where no party has sort of ideally overall control, also if anyone is to lose their funds, or if they misplace private keys, or if there's some user errors, then they will also lose funds. So there are risks to the individuals. But also the last advantage is potentially DeFi offers a more robust financial system. Perhaps it could be the case that single points of failure, such as we saw in traditional finance with Lehman Brothers and other banks, which famously collapsed in 2008 in that financial crisis, perhaps we can move to a financial system where these single points of failure are eliminated. Okay, so I've sort of done a warm-up. I talked about what DeFi is, why people care, the possible advantages, and now we'll start to get more into what we do in the paper. So looking at from above, there are several different types of DeFi protocol. So there are protocols for lending, for decentralized exchange, for derivatives, for payments, and others. In the paper, we look only at protocols for lending. And what we do in the paper is we investigate some of the DeFi risks, focusing on lending protocols. And we look at lending protocols because as of today, that is a figure I computed earlier on today, the amount of capital locked in DeFi lending protocols versus the total is 73%. So they constitute most of DeFi. So we do essentially three things in the paper. So the first is that we look at attacks on the governance mechanism of one protocol, which is MakerDAO. We then, secondly, formalize DeFi lending protocols more generally, so moving away from MakerDAO and looking at the sort of class of lending protocols and provide some mathematical framework to think about the economic security. And then third, we do some economic stress testing of a stylized example. And the idea with the stress testing is to present a framework that can be used to understand one type of risk that is existent in lending protocols that depend for their security on over-collateralization. So today we're going to just focus on 1 and 3. So let's start then with 1. So this is where we, in the paper, present a set of governance attack strategies on MakerDAO. Okay, so what is a governance attack? It seems like a natural question to ask at this point. Well, we have to think about what a governance mechanism is. So a governance mechanism, in particular as implemented in MakerDAO, allows a set of stakeholders to reach a decision on some arbitrary change within a certain system. And in MakerDAO, this is implemented via a voting mechanism. So holders of the Maker token are able to vote on proposed changes. And they do that by staking MKR tokens. And then they are able to elect a new contract as the executive contract if that contract has the most tokens staked on it. So if there are enough MKR staked on a particular contract, it becomes the executive contract, and you're able to enact the changes to system parameters that that contract embodies. So this is essentially the main vulnerability that we are looking at in this work. And what we do is, in this paper, we show the feasibility of attacking the governance mechanism in Maker, following on from an excellent blog post by Mika Zoltu, who first proposed this attack. But what we do is we show its feasibility through two distinct strategies, which I'll come on to shortly. And the main takeaway here is that if you're able to attack the governance mechanism, particularly if you're able to elect a malicious contract as the executive contract, it is possible, or was possible, to steal all of the funds that are locked in Maker, locked as collateral. So this figure shows the amount of MKR that is actually staked on different executive contracts, or has been staked historically. So there are a few things to observe from this. So well, firstly, the y-axis is showing you how many MKR tokens are staked. And what you can see first is it's quite volatile. So there's a lot of variability in how much Maker is staked on a given executive contract. Occasionally, the amount that is staked is dropping below 50,000 MKR. But also, this is of some interest, is that it does also spike to 160,000 MKR just after the blog post was initially released. So you can see that just here. Okay. Okay, so I said we would talk about two distinct strategies. So these are the strategies. First is crowdfunding, and the second is flash loans. So let's start with the crowdfunding strategy, which allows you to attack the governance mechanism. Okay, so what this does is, in a sense, quite intuitive. The goal is to amass sufficient MKR collateral to be able to elect a malicious contract as the executive contract. So the question becomes, how can we amass enough capital to do that? And what the crowdfunding strategy does is it tries to crowdsource this capital. So by doing this, in a sense, it makes it easier because you don't need a single individual to have sufficient capital themselves to be able to undertake this attack, but also potentially makes the attack sort of sneakier or harder to detect because you distribute the tokens across a number of addresses. And then what you do is you program a crowd sort of pooling or crowdfunding contract to say, once we have enough MKR for the attack in this contract, then let's stake these funds on a malicious executive contract. And in doing so, you can then withdraw the collateral from the Maker ecosystem and also cause other forms of harm. So by this first attack strategy, the time that we first wrote this, we found that we expected this to have a profitability of about 263 million US dollars. So this is a real, at the time, was a real vulnerability. And our concerns were not just academic. So here is an admittedly informal Twitter poll that was conducted. The question is, if someone was to write a contract that allowed you to pull MKR and essentially undertake the sort of attack that we were discussing, would you be interested if you could steal $300 million worth of collateral locked in the system? And I mean, most people said yes. So that in a nutshell was the crowdfunding strategy. The second strategy was one that involved flash loans. So these emerged really right as we were drafting the paper. And what a flash loan allows you to do is take out an uncollateralized sum of capital, provided that you are able to repay it, and everything must be executed in a single transaction. So what this opens up is the possibility of using a flash loan to source the liquidity directly, so to source the MKR tokens that are needed to undertake this governance attack. So what you would essentially do to undertake this attack is you would try to find a pool of liquidity that allowed you to take out flash loans that was large enough to borrow enough capital so that in another marketplace where you could exchange that capital for MKR, you could buy enough MKR tokens to stake on the contract and do harm to the maker governance mechanism. So this particularly malevolent attack strategy doesn't at all require any of the crowdfunding apparatus, and instead leverages a new development in DeFi to actually undertake this attack. And again, we found similarly this is expected, or was expected to be quite profitable, or very profitable, I should say, so $191 million. But that was on the assumption that there was enough liquidity available so that you could, of the funds that you borrowed from the Flash loans pool, so say you had borrowed Ether, you need enough Ether to be borrowable from that pool, and then you also need to be able to buy that, convert that capital to another, to the MKR token on a different venue. So there are assumptions on liquidity there. Okay. So just to sort of recap a bit about where we are. So what I did was just talked about two different attack strategies that targeted the maker governance mechanism specifically. So we were looking at MakerDAO alone and looking at how there are risks in this ecosystem related to governance, and we presented different attack strategies there. So what I'm now turning to is a broader framework that allows you to do some economic stress testing. So in the context of lending protocols, this framework allows us to see situations in which these protocols could sort of break down. So financial crises, are they an inexorable feature of the world economy? Well, here's some data from the World Bank. You can see the relative volatility in world GDP growth. There are some significant spikes and troughs, and I think one of the questions lurking in the background with DeFi is, might it be something that allows us to dampen the severity of these fluctuations? But also, we have to acknowledge that these fluctuations seem somehow, at least at the moment, to be inevitable. So the question becomes, in the event of such a fluctuation, are DeFi protocols likely to be resilient to significant price shocks? Okay, so this is the approach that we took to stress testing. So we simulated a price crash event on a DeFi lending protocol that is stylized. So it's meant to reflect the sort of main characteristics of the sort of main lending protocols, but we're not targeting one particular protocol. What these protocols share is that the economic security depends critically on their over-collateralization. So when you go to one of these lending protocols, you borrow up to some threshold. So you deposit collateral and you can borrow up to some percentage of that collateral, because you're ensuring that if you're unable to pay back the loan, then the collateral that you have posted will be seized and can be used to pay down your debt. But if this over-collateralization property no longer holds, then of course this poses a security vulnerability. So in addition, whether these collateral margins themselves can be maintained depends on, among other things, whether there is enough market liquidity to actually maintain these margins. So what that means will become clear shortly. But in short, for many DeFi lending protocols, under-collateralization is something that they want to avoid. Okay, so what we do is we take ETH and we take a sort of synthetic reserve asset, and we simulate the price evolution of ETH using geometric Brownian motion. So what these plots show is just 5,000 different possible evolutions of the ETH price on the left here, and then on the right of this reserve asset. The reserve asset is parameterized to be less volatile than ETH itself. The thought there being a protocol would try to choose a reserve asset that was less volatile. And then so I'll just go back, from what we take here, we take the worst outcome in terms of the ETH price, and we ask the question, for different levels of correlation between the collateral asset on the left in this figure and the reserve asset on the right, how might the margin of over-collateralization evolve for a protocol as a whole? So what this figure here is showing is a very sharp fall in the price of ETH. And in particular, it is one that is bad enough to cause what we see in this figure. So in this figure, what we have is essentially on the right diagram, we have a under collateralization event where the margin goes negative. So that's shown here by the margin going below zero as a result of the collateral asset and the reserve asset not being liquidated quickly enough to enable a system to pay down a debt. So more broadly, what we have in this figure, each panel shows different levels of debt, so increasing left to right. These solid lines show the evolution of the collateral margin, or the margin, not the collateral margin, the margin, sorry. The dashed lines show the remaining debt that exists in the system for different levels of liquidity. So in say this case, we can see that in the leftmost figure, while there is a price crash, the debt was small enough that it was actually possible to liquidate the collateralizing assets quickly enough before the margin could fall and become negative. But as the debt level increases, we see that that is no longer possible. So then what we looked at in the paper was, is it possible to dampen the effect of these price shocks by using a reserve asset that is not so correlated to the collateral asset? So here this figure shows a weak positive correlation between the reserve asset and the collateral asset. So perhaps just to contrast this, so this is the weak positive. If I go back, you can see here this is strong positive. So now in the new figure, the reserve asset is following, is less correlated to the shocks in that the ETH price series receives. In this situation, what we can see is that it seems to mitigate some of the effects. So here, for the same levels of debt in each of these panels, we can see that by the time we get to the rightmost figure, within the same time frame, the crisis does not seem to have precipitated, because now the reserve asset is able to better prop up the protocol as a whole, and in a sense give it more time to liquidate. And then finally, for completeness, we also consider a case if you're able to find a reserve asset that is strongly negatively correlated to the collateral asset. So here you can see sort of what you would expect, which is that the now the margin remains much more healthy, and in some cases relative to earlier figures actually is actually improves as a result of the fall in the price of the ETH here. So here, this is one of the last figures I'll present. We just look at how this initial ETH liquidity really matters in combination with the debt level for how quickly a crisis might occur. So the intuition here is that as a market becomes or offers more liquidity, you're able to effectively increase the amount of time before a crisis occurs. You're essentially able to get a protocol out of trouble more quickly. Okay, so just a quick recap. So now I've talked about the economic stress testing framework, in addition to the attacks specifically on Maker. And what I'm going to do by way of conclusion is just to talk a little bit about some of the consequences of this work, and in particular what happened in relation to our governance attack. So we reached out to Maker around the time of first drafting the paper, so on the 7th of Feb. They were very receptive, and we engaged in a very constructive dialogue. We essentially discussed the fact that we had managed to show the feasibility of the attack. And then we had a call with them about a week later. We sent them a draft of the paper. And then once we realized the additional risk posed by the flash loan strategy, we contacted them again. And so we had sort of a sustained back and forth. And then 21st of February, Maker announced that the governance security module had been activated with a delay period of 24 hours, which actually serves to mitigate the attack. So what that does is essentially puts a buffer between a new contract being elected and it actually making, or basically a gap between election and inaction. So it enables contracts to be checked that they're not going to be malicious and do malicious harm. So that's sort of the interaction we had with Maker in the spirit of responsible disclosure. And of course, very much a fan of the work they're doing. And it was a very constructive dialogue that we had with them. So that's kind of a summary of the paper. So thanks very much, and please feel free to fire away with any questions.
Ooh, thank you, Luis. It was really nice talk, really informative. I think many of us learned a lot. Shall I shoot with questions, or like, don't be shy, guys, shoot questions in the chat section. But actually, I have quite a lot. So can you go back to the very beginning of your slideshow? Like, I'm not an expert in the MakerDAO protocol, so I think maybe for a lot of people it was not clear, and also for me, like, let's say I attack the protocol and I elect a malicious executive contract. What can I do with the MakerDAO protocol? What are the extent of this attack? You mentioned some security parameters, what the attacker can access or set. What are these? How? Yeah, in more detail, how this attack would look like. So I elect a malicious executive contract, and then what happens?
Right, sure. So you're able to do a few things that are potentially very beneficial to the attacker. So there is collateral that is held within the Maker system that collateralizes the collateralized debt positions. So these CDPs all have a certain amount of collateral in them, specified by various ratios. And what's one of the things you can do with this attack is you can transfer this collateral to yourself. So in a sense, this is just sort of straightforward theft. The other thing that you can do is you can also mint yourself DAI, which is a token native to the to the protocol itself. By minting this DAI, you could go to other venues that offer a trading pair between DAI and another asset, and you could exchange this DAI for these other types of token, and then you would essentially amass other types of token as well. There's likely to be a degree of time pressure with that, because it's possible that with such an attack, the DAI that you have minted itself is going to start to become worthless. So yeah, those are the two sort of main things that you can do by electing a new contract.
It's crazy. What's the design ratio or rationality allowing anyone to set and just grab all the collateral? I mean, it's just crazy that the protocol has this possibility. I don't know.
Yeah, I think that the issue, I think that the issue, and I'm very sympathetic to the trade-off that is faced. But the issue that they face is that there is a trade-off between wanting to enforce a delay in a protocol, so that if you elect a new contract, you sort of put it through some type of vetting to make sure it's okay. And also, on the other side, you don't want this. You actually want to be able to be very responsive if you find some type of other systemic problem. So one of the trade-offs that emerged is that there's this tension between being able to be very reactive with one of these protocols versus being able to verify that what is happening is safe. Yeah.
There's one more question in the chat section. So,
right.
How do you see the feasibility of an Oracle attack as a feeder, or through a P+epsilon attack, if you know about it, in order to wrongly trigger and exploit the liquidation mechanism?
Right. I mean, so I'm aware of these attacks. I guess, of course, yeah, it's to some extent feasible. I know that Maker have taken many steps to try to distribute the sources from which they gather their price information. But yes, sure. I mean, this itself is another key type of risk, the Oracle risk that's posed.
I just have one more question from my side. That if you go back to the very beginning of your talk, like there was a sharp decline of collateral. Like put money in, around March. So
yeah.
So what was the reason? That was like the Black Thursday of COVID-19, or what was that sharp decline?
Yes, it was around that time. Yeah, I mean, it's around the same time that there was very, very significant volatility in all financial markets, or most financial markets. Yeah.
And then people just liquidated Psy, or what happened? I don't know.
Yeah, I think the dynamics. I'm not entirely clear on what they were, but I gather that one of the main issues was protocols becoming like CDPs getting liquidated quite quickly, related to falls in the price of ETH and other collateral assets. So I think this reflects the sort of market panic that was seemed to be prevalent at that time.
Thank you. I don't know if there's any more question.
Yeah, perhaps I would have one general questions. Hi guys, this is Daniel. So what I'm thinking of a little bit, that the problem is in this whole decentralized finance field that practically DAI is the basic coin of everything, because it's almost the only one stable coin that doesn't theoretically has counterpart risk. So do you guys have any idea what happens if there's such an attack? than with other decentralized protocols? I mean, then practically the whole this DeFi space collapses, or do you have any idea what can be the impact apart from Maker?
Right. Well, I mean, this is a very good point. Yes, I mean, it does seem like there is a real possibility of financial contagion in these protocols, and while I don't cover it here, I mean, it's clear that this is really something that we need to be concerned about as well, because yeah, I mean, it's all very well talking about decentralization, but if you're sort of putting all of your eggs in one basket with certain types of protocol, or building sort of systemic reliance on very few components, then this risk of contagion does seem very material.